Welcome back. This is Open Exchange, and we are coming to you live from the CNBC-TV18 Motilal Oswal studio. Well, in the next few minutes, we'll be getting the pre-opened rate, so it's a good time actually to get in some derivative strategies. Manoj Muralidharan, VP at Derivatives at Realty Broking, joins us on the show. Hi, Manoj. Good morning. What's your approach? What is the strategy you have in place for the Nifty? And fill us in with your picks as well.
Good morning, Nigel. Nigel, this April series, after it has started, you would see that, the last 8 days has been on a short covering note. Even the FIs, which had a short positioning, almost 88, 90 odd percent, they have trimmed it down to 60%. 45 to 60% is generally an average with which the FIs roll or get into a new position. And we have seen the bank Nifty outperform. Now, what we believe is, if you see the open interest for Nifty is very low, it's just at 93 odd lakhs. Generally, mid of the month, it is at least a 1 crore, 1.05 crore, saying that, there is more buying, or the instrument that the traders are using would be futures. But as of now, we believe that Nifty might get into a consolidation because the option selling trades are quite rampant. And 17,800 call option and 17,600 put option for the Nifty seems to be the level where huge amount of selling is there. So we expect Nifty to be in this range. Though the Bank Nifty has been outperforming the ratio, we look into a ratio between Bank Nifty and Nifty, which is almost at 2.38 as of now. So we're expecting some more outperformance, but the major thing is Nifty would be in a range bound mode, and there can be some sector specific move. So selling a call and put option of this so-called strike, the combination is somewhere close to 120 odd rupees, becomes a good trade. The target can be 40 rupees on that.
Individual stocks? What about individual stocks?
Stock specific, now we believe Reliance can surprise on the upside. There can be a possible 3.5 to 4% move. So 23.60 to 65 becomes a good buy. We're expecting Reliance to head towards 24.20 to 24.30 in the short term. So that becomes a buy. And even in the Bank Nifty, as I mentioned, the PSU part and especially stocks like SBI have seen good delivery-based buying and a long build-up. So we believe some outperformance from that PSU part into the Bank Nifty can be the trade as of now. So you can vouch or go in for a 540 strike call option for SBI. I guess the trading is closer to 10 rupees. Stop loss of 4, and we're expecting a good target of close to 20 rupees on that trade.
Okay, all right. Thanks a lot, Manoj. Have a good day. Let's talk about some sectors that could be in focus and some stocks as well. The auto space could be in focus today. Very interesting note from CLSA put out this morning, where they are now getting constructive on the sector. They met clients across, different parts of Asia, clients in Hong Kong, Singapore, etc. And the clients are positive on the auto sector for a couple of reasons. One is the recent stock price fall. So they believe that this is a good entry point for auto names. And the other is the resilience as far as demand is concerned. Clients are also optimistic on the fact that there is an EBITDA margin improvement expected in FY24 because of the fall in commodity prices. Now, a couple of more things. In the four-wheeler space, they prefer Maruti Suzuki and Tata Motors. In the two-wheeler space, clients like Bajaj Auto, because of the dividend yield, performance. Also, it's a 4% dividend yield that they're looking at, as well as the upcoming launches from Bajaj Auto stable, which could be positive triggers. Now, for Tata Motors, there's an improvement, a clear improvement in the Jaguar Land Rover business, and the strong domestic business has also made clients positive over there. So I want to get Amisha Vora into this conversation. Amisha, we were discussing this a while back, but particularly on names like Tata Motors, I mean, these are stocks that have not done much for investors in the last couple of years. Do you think that multi-year lull period has now come to an end? And if yes, what are the stocks that you like?
So one is that when we talk about within India, in India in particular, that there is a rate hike pause. The rate sensitives should do well, and auto is one amongst them. We also see that there is a huge amount of spending continuing on infrastructure, which definitely has a lot of multiplier impact. And lastly, in the election year also, as we know, a lot of spending will increase. Having said that the macro is good, coming to Tata Motors, for them, opening up of China and China doing really well will also matter a lot. So while in India, their EV business is continuing to do really well, the global business has a big leg in China, and that bouncing back will also help the stock. So all in all, I feel that yes, we are overweight on auto substantially as a house. Within that, of course, we like Maruti also because of their product launches, as also the space that they are in. And in the commercial vehicles, we like Ashok Leyland. But Tata Motors, because of the additional play on China opening up, plus the domestic EV space, we like that.
Okay. All right. Talking about Tata Motors, let's talk about another Tata Group company. Sonal is joining us to tell us about Tata Chemicals. There have been price cuts out there. And yesterday, we won't get the intraday chart, but the stock in the last 30 minutes saw a sharp fall in trade. Sonal, tell us more.
Thank you for that. Well, yes, Tata Chemicals is in focus. They've taken a price hike to the tune of 3 to 4%. This is in their soda ash product. And this price cut has come in after 6 months. The last one that they had taken was in the month of November. Now, Kotak Institutional Equities says that this cut comes amid falling soda ash prices in China since mid-March. Market has reacted to the unexpected news of substantial capacity addition in one of the geographies and major market, that is Mongolia, from 2023 itself. They see this as an incremental negative for soda ash prices, so that means there could be further cuts that companies would take across the globe. There are uncertainties which are remaining around demand and supply, and this is something which will need monitoring as well, according to Kotak. Soda ash business contributes around 15 to 20% of the consolidated EBITDA, and price cuts should somewhat be mitigated by lower coal prices that the company is seeing. So lower raw material prices will mitigate the impact of cut in prices as well. While Kotak expects Q4 to be very strong for the company due to firm realizations on US exports, the outlook for second half of calendar year 2023 is very uncertain and less clear. Soda ash realizations are seeing cut after continuous increase in last 2 years. So this could be a spot of worry for Tata Chemicals.
Okay, got that. Thanks very much, Sonal. By the way, the pre-open Nifty suggesting an uplift of around 70 odd points, and Infosys after yesterday's huge slumber, complete slam dunk, is up about 1%. ICICI Bank, Kotak Mahindra Bank, Reliance. These are some of the stocks that are bouncing on the upside in the pre-open. And the pre-open rates seem to suggest that the market really wants to go back to those levels of around 17,800. Let's see if this is how it indeed transpires once the actual opening hits us. Let's keep it to some interesting brokerage commentary that we're picking up from the street. Abhishek is joining in. There are some notes on affordable housing finance companies. What's the takeaway, Abhishek?
Well, Morgan Stanley has written a note. They have initiated coverage on housing finance companies. They say that, secular growth opportunity is there in a systematically important sector. So opportunity is significantly higher outside the top 4 cities and with disbursal ticket size of less than 25 lakhs. So space is niche, underpenetrated, has a secular growth outlook with pricing power and ESG positive as well. So thesis is that there is stronger growth outlook right now, and with asset quality which has been tested by COVID positive, valuations have derated and peak rates are inside. These rates are the interest rates. So valuations have significantly derated to reasonable or let's say attractive levels. They prefer Aptus and Home First Finance given the fact that it's smaller balance sheet in size and hence higher loan growth potential as well as better business run with risk profiles actually improving over there, and the current valuations also augur well for investors to invest in. So they have Aptus with an upside of 27% overweight rating over there. Home First Finance, the rating is overweight with a target price which is an upside of 25%. Avas Fin, the target price is only 6% upside but equal weight rating because the valuations are already on the stronger side or on the higher side. And Canfin Homes, they have an equal weight rating. Target price is around 3 to 4% below the CMP. A much larger balance sheet, bank competition and promoter stake sale is a huge overhang on the stock. Back to you.
All right, thanks a lot for that. So those are a couple of more stocks in focus. But just wanted to mention, some stocks in pre-opening. The pre-opening rates are settled higher, actually, up almost about 0.3%. Infosys is making a bit of a comeback, so that's interesting. Let's see, it's actually the biggest Nifty gainer right now, Infosys, up almost about 1%. So let's see if there's buying action after the disappointment yesterday. Angel One is the other stock. Very good numbers coming through. The margins are at a 2-year high. EBITDA is up 20%, and Angel One is up almost about 4%. And plenty of other stocks actually looking pretty good. Poonawalla FinCorp is also trending in the green. There's news flow there. Z Entertainment is up almost about 1%. Let's do one thing. since, a lot of heavyweights are piling on the gains now, ICICI Bank, Infosys, HCL Tech. Let's get some 9-10 calls going. Sudarshan is back with us and Mitesh as well. Sudarshan, what do you do in a market like this? Looks like there could be a pullback. Are you going to jump onto it? And what's the 9-10 call?
Absolutely. You must buy small intraday dips today and expect the markets to go up. So how you buy the dips is a different question. You can choose any method. There are many. GAIL is a buying opportunity with a stop under 105.
And Mitesh, how about you?
I will recommend to buy on EV Capital with a stop at 160 for targets of 175.
Okay, got that, gentlemen. Amisha, before we let you go, I wanted to get your thoughts on SBI Card. There's growth, but the growth is slowing down in terms of spends per card, also the incremental customers that they're adding. What's your view on the stock?
So overall, with more and more usage of other digital mediums, I think that there is no re-rating upside for sure in this stock. The growth will continue. It's a robust, high ROE business. I would be very neutral. We don't cover it actively, but I will be very neutral on the stock and its prospects and not very, very strongly positive on it.
Okay, all right, got that, Amisha. Thank you very much for being with us this morning and taking us through a lot of that opinion. You have a good day. In fact, since we're talking about SBI Card, let's actually get to the numbers. Abhishek is joining in. Abhishek, how do they look like?
Well, RBI's data for, credit card and especially for SBI Card suggests that card issuances for SBI Card is up nearly about 21.8% YOY and about 1.55% on a month-on-month basis. The spends are up only 20.7% YOY and about 11.8% month-on-month. This suggests that average spends is down about 0.9% YOY and up about 10.1% month-on-month. We have Morgan Stanley, who has written on SBI Cards. They have an overweight rating and a target price of 925 per share. They say that the industry spends growth has moderated to 28% YOY in March. This compares to 38% growth on a YOY basis in February. So SBI Card actually grew slower than industry level at around 21%. SBI's market share in card in force has actually come down on a month-on-month basis with 13% share in incremental cards in March. Also, we have Jefferies on SBI Card. They have a buy recommendation and a target price of 900 per share. They say that SBI Card's outstanding grew 22% YOY and spends grew 28% YOY, which was on expected line. But the share of industry net card addition has fallen a month-on-month basis. So spends share have dipped about 63 basis point month-on-month, led by lower online spends for SBI Cards. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Vivek joins us to tell us about L&T. Vivek?
Well, good morning. A couple of very interesting brokerage notes have come in on L&T. So Jefferies has gone ahead and analyzed the kind of ordering activity and the impact that a pre-election here typically has on L&T. Now, investors have been concerned about the pre-election impact on the order book as well as the share price. However, what they've done is they've gone ahead and analyzed historically that actually there has been an increase as far as the order flow is concerned, and it's actually risen by double digits in the past 3 pre-election year periods, and which is why they're saying that it's not as big a concern as it is now being made out to be. In fact, what they're saying is that share price has actually held up into elections and has been posted mute since. When you're talking about Macquarie continues to retain an outperform stance on the company. They're saying that one concern has been the fact that the near-term weakness in the IT subsidiary performance could actually go ahead and weigh in on the share price performance. However, the defense orders is something that is gaining momentum, and which is why they continue to have confidence as far as L&T is concerned.
All right, thanks a lot for that. So that's on L&T, but we're just, counting down to the market opening. Looks like it's going to be a decent opening for the market. Remember, the Nifty has been facing a bit of resistance around the 17,850 to 17,900 mark. And after yesterday's disappointment, this morning, will the dips get bought? That time will tell, but it seems like that could be the case. The US markets were also pretty decent. We had some good earnings from Just Dial, Angel One. The only thing is FI sold in the cash markets after 10 days of buying. But I wanted Mitesh Thakkar to come in on a couple of stocks. Mitesh, on Infosys, after that steep fall we saw yesterday, the sense you're getting is, at least in pre-opening, the stock is moving up higher. From a technical standpoint, is the risk-reward favorable?
Yeah, I think with the big gap down, the stock is clearly trending negatively. But given the fact that yesterday it fell 9.4% on the closing and it was down about 15% intraday, I think a pullback to about 1300, 1320 is possible. I would want to rather short there around 1320 or levels if we get it with the stop about 1350.
Okay, got that. Mitesh, just another quick question. Yesterday, the move that we saw on the FMCG side of the market, Nestle was up about 4-5%. ITC, did you see any interesting chart patterns? I mean, anything that looks like it could be a starting of a trend?
A couple of them. While ITC is something which we recommended last week, but I think yesterday there were fresh breakouts on the chart of Nestle and Britannia. Disclaimer: we have some futures position on Britannia. Both these stocks, I think, have given a good correction in the month of March and now are trying to reverse that. I'm hoping that Britannia will head towards 45, 50, 60, the recent swing high and all-time highs, and then even eventually cross them. Similarly, on Nestle, I think the stock is heading towards the highs of 20,800.
All right, 20,800 you said on Nestle. Got it. We're just counting down to the market opening, which will come through in about 30 seconds from now. So stay tuned for that. About 60 points higher is what the Nifty is indicating. So it looks like it's going to be a good start. Led largely by Infosys, ICICI Bank, HCL Tech that comes out with its numbers on Thursday, and a couple of other names. So here's the first tick on the index. Indices Bank is topping the charts, up about 0.5%. The index itself is up marginally, not too much, about 20 points higher. So it's largely flat with a bit of a positive bias. The mid-cap index is also flat with about a 60-point gain right now. The Bank Nifty is also just trending a tad bit in the green. So the first take after yesterday's steep fall is just consolidation around the 17,700 level. Infosys is clawing back a tad bit, 0.5% higher. Indices Bank is up about 0.3%. Coal India, Grasim, Adani Ports are a couple of other stocks that are trending in the green right now. Interesting moves on HCL Tech. Comes out with its numbers ahead, just a couple of days from now on Thursday. So ahead of that, it's up almost about 0.5%. And Maruti Suzuki, a couple of these auto stocks are also looking good. We had that CLSA note, which was constructive. On the downside, pharma stocks are under pressure. Cipla, Sun Pharma, Apollo Hospitals are your top three Nifty losers, followed by Hero MotoCorp, SBI Life, BPCL. ITC is just taking a bit of a breather after hitting a record high yesterday. TCS is still sulking a tad bit. Titan is a little bit in the red, not too much. But largely, you'd have to say the market is just buying time around these levels. No directional call at the moment. But the advance decline ratio is well in favor of the advances. So that's a good thing. The bulls are trying their best to claw back. But let's see, not convincing just yet, but nevertheless a tad bit in the green.
Well, that's right. Stock-specific action continues, though, Sonia. So quick heel, the numbers were very, very poor in a seasonally strong quarter, and the guidance as well going ahead is a little bit softish. So that stock, I think, is down close to around 8-9%, or quick heel should come up for you on the screen, down 8%. Just Dial, the numbers look quite good. The margins came at the highest we've seen in the last 2 years or so, at around 14.5%. So that's up close to around 5.5%. Angel One, the quarter 4 EBITDA was up by close to around 20%. The margins expand by around 400 basis points as well. That's off to the races, up close to around 5.5% odd. Godavari Power and Ispat, the mining operations at one of their mines, I know mines, that in fact, has resumed. So that stock, in fact, is up and about in today's trading session. A couple of other notable names on the downside. You have Tata Chemicals. Yesterday, the stock was down close to around 3% in the final hour of trade. It's followed up with another 2% cut because they have cut the light and dense soda ash prices by around 3 to around 4% odd. Fears of oversupply coming in there. Soda ash contributes around 15 to around 20%, as Sonal just told us, to the total EBITDA. So that stock as well is under a little bit pressure. A couple of stocks are reacting post large trades that we saw yesterday. So 361 WAM, that had opened up in the gain with close to around 1.5%, a pending large trade getting cleared out of the way. Z Entertainment as well, Oppenheimer sold close to around 5 crore shares odd at around 204 rupees. Yesterday the stock was a little bit under pressure. Today it's up close to around 1.5%. And Poonawalla Finance, the promoter entity, sold close to around 80 lakh shares in trade yesterday. It gained from the lows yesterday. Today as well up close to around 0.5% odd. So a fairly decent start to trade after yesterday's pullback.
Yes, not bad, about 40 points higher. If you're looking for some more newsmakers, watch out for Jubilant FoodWorks. Coca-Cola has put about 100 crores in one of their arms. That stock's up about 3%. Nestle is continuing its breakout from yesterday. Mitesh just mentioned that he's seeing fresh levels, fresh breakouts of both Britannia and Nestle on the charts. 1% up on that stock. There's some buying in HDFC Life. All in all, the market looks okay. About 40 points up on the Nifty, trying to stabilize. Banks are trying to add and build a little bit of momentum, 120 odd points up on the Bank Nifty. Mid-caps are also stable for the time being. So not a bad start at all, considering that the Asian picture was fairly muddled. So it is advantage bulls, at least for the time being. The market trying to get back to earlier levels of 17,800 plus. Well, it's a good time to then get our conversation going with the market master this morning. Saurabh Mukherjee, founder at Marcellus Investment Managers, is with us. Saurabh, good morning. Great to have you on the show as always. Been a long time, at least, that I've had a chance to chat with you. Tell us, the market seems to be at a very interesting juncture, and earnings season has started off in the reverse mode, right? Typically, it's IT that starts it off in style, and then you have the tail enders coming in. But as you look at the market right now, how are you feeling? Do you think earnings will live up to expectations? Because the rest of the picture, whether it's the dollar, US yields, US recession, there's a lot of confusing elements that are out there.
So, morning, Subhi. I think if you look at the two big profit generators that have reported so far, right, HDFC Bank and TCS, I think respectively the second and third largest profit generators in India. I thought those were really good results. So I taken both our portfolio stocks for us. So disclaimer here, I own them. My parents through our portfolios, through Marcellus's portfolios own them, and so do Marcellus's 10,000 clients. So HDFC Bank is 21% profit growth, 17% loan growth, and HDFC Bank has been doing this for 25, 26 years, nothing new here. And even TCS, in what's supposed to be a US recession or close to a US recession, TCS is growing profits in mid-teens, some of the strongest order book growth I've seen in many years, 25% operating margin. TCS's guidance is also very strong. So I thought these were sparkling results. And if you consider that this comes in the context of a world in which the relationship between the West and China is deteriorating by the week, and therefore the probability of heavy FII flows into India is growing by the week. We've already seen some of that come through this month. I think this is a very nice situation. You've got big Indian companies like TCS, like HDFC Bank, reporting sparkling results. You've got FII flows coming in, the world tilting towards India, the domestic economy in good shape. So difficult to really imagine what more would a long-term investor expect or want from either big Indian companies or from the Indian economy.
Saurabh, I take your point that you've been invested in TCS for a while, but I don't know how you can call these results sparkling, because in TCS's own admission, the sentiment has weakened in Feb and March. Their constant currency growth was not even 1%. Their margins that they reported were under their own guidance, below 25%. So in what context are you calling it sparkling? I'm asking because at a time when the recession has not even kicked in, you're seeing numbers like this. So what happens towards the end of the year? This is Sonia.
Sorry, Sonia. The hallmark of all great Indian companies, right? All the great Indian compounders always downplay results. I've never seen, say, a Pidilite or a Titan or a Nestle or an HDFC Bank or a TCS hype up the future. I've never seen a single high quality compounder hype up the future. So TCS is publishing results at a time when you've got 4 large Western banks going under in the preceding 4 weeks. What would we expect them to say? It would be bonkers for them to say that the outlook is great. And why should you and I care about 2 months, 6 months, 1 year forward guidance from a company which has been around for 40 years, which has been listed for 20 years, compounding consistently cash flows and share price at 20% for 20 years? Why should you and I lose too much sleep about guidance, right? Look at the results. Look at the operating margins, look at the deal wins, look at the YOY growth in revenues and profits. Consider the environment in which these people are operating. How these results are anything other than sparkling beats me. And why people look at guidance from companies which have been reporting for 80 quarters as listed entities, companies that are known to be conservative in how they think about the future. That's how great companies think. So in every which way, for anybody who's watching this, if you care about long-term investing, these are good results from proven companies. They're giving you a sensible picture of the world. They don't hype up their stock. They do the right thing for their shareholders. And in a difficult world, a world in which the China and the West is at loggerheads with each other, a world in which 4 Western banks have failed in the last 30 days, in a difficult world, these are outstanding results, I think.
Okay, all right. Hi, Saurabh. Good morning. Nigel on this side. So we take your point then. For a long-term investor, TCS could be part of your portfolio now, given that we're likely to see some bit of softness. Got that. What about the pharma space? In the past, we've asked you about Divi's. I think the last time we chatted as well, you said it's a quality franchise. It's going to be looking up from here on. And you would maintain that you all will add positions, at those levels. Now, from those lows, the stock has risen a little bit. And the export data that was reported was quite positive. Do you think Divi's will look up from here? From the peak, it seemed quite a large correction. So I ask you.
So November, December, we doubled our position. So I think going into Oct, I think it was 3% of consistent compounders. And then through Jan, Feb, we made it close to 8% of the portfolio. So it's a big holding for us. And again, similar position on DVs, right? They too were listed around 20 years ago. So if you look at the 20-year track record, this is a company which from nothing has built itself into the 5th largest API manufacturer in the world. I would say amongst the large Indian pharma companies, by far the highest return on capital generator. You speak to any Divi's client. Divi's clients are the world's largest pharma companies. I would say 6 of the world's largest pharma companies, I reckon, account for around 80% of Divi's profits. You speak to them, as we do quite regularly, and they are giving us a very clear picture that America is turning away from China as a source of API. China makes 90% of the world's API. As America turns away from China as a source of the world's API, Divi's is a natural place for them to go to. What Divi's did on molnupiravir over COVID has won them many friends in the West. So for those who have short memories, in the space of 100 days, Divi's delivered for Merck molnupiravir, and Merck thus supplied the whole world with molnupiravir in 100 days flat at a time when global supply chains were supposed to be in trouble, courtesy China, courtesy COVID. So impeccable track record of high quality delivery to the world's largest pharma companies, and therefore we unhesitatingly doubled the position through the winter months. The export data, whatever it is perked up now, but short-term data we don't lose too much sleep about. Focus on great companies with impeccable governance, capabilities, distinctive capabilities that their competitors don't have, and buy as much as you can when others are refusing to buy those stocks. That's something we've done for a long time. It served us in good stead. I think in Divi's lab as well, our expectation is over the next 2 to 3 years, this company will get plenty of business from the Western pharma companies.
Let's talk about a sector that you've tracked for very long and companies that you've sort of looked at for several decades now, I guess, Saurabh. I'm talking about the consumer names. And if I'm looking at the right disclosure sheet, then Nestle, Page, Pidilite, all of them are still in your consistent compounders. What's the thought process here? Because again, there's been a debate about how the lower end of the consumer market is getting impacted because of high inflation, high interest rates. It's all about the premium end, but that's not what FMCG represents. So how are you looking at it, considering we don't know, the monsoon is a joker in the room right now. We don't know if it sort of gets worse before it gets better. What are you expecting? I know I'm not talking about the long-term question, but in the near term, let's say this year, what are you expecting the consumer companies in your portfolio to do?
So look, I think I'll also add Amritanjan. So in our Little Champs portfolio, we also have Amritanjan. And as almost everybody in India now knows, we used to own Relaxo. So if I split this into 2 parts, right, and this is, I think, a relatively established structural trend now over the last 6-7 years, and I reckon this will last for several years to come. The strata of society that, say, represent CNBC viewers is doing very well. Whether it's their investment portfolios, whether it's their cash flows in terms of earnings or their business profits, the strata of society represented by the viewers who are watching this program is doing very well in India. And any play around that, whether I look at our investment in Titan or Asian Paints or indeed Pidilite, any play around affluence, middle class, upper middle class affluence in India, we're seeing sparkling results. When we talk with the management teams, we're seeing enormous confidence about the years ahead, and we can also see heavy capex, right? So, for example, Asian Paints 5 months ago announced $1 billion of capex. Pidilite, I think, the best part of $1 billion of capex, and so on. So that part is relatively straightforward, and we stay heavily invested in all of these firms, Titan and Asian Paints, Pidilite, and so on. The part that is struggling, Surdeep, you're right to point out, is anything which caters to people earning, say, 2 lakhs per annum or less. And I would say around 300 out of India's workforce of 500 million, I would say 300 million earns 2 lakhs or less. That's the strata where there seems to be a real challenge with with income going faster than inflation. Effectively, real wages are going down for these people. And that's why, in our Relaxo investment, the chappal piece took such a tonking. And say in our investment in Amritanjan, even in the pain relief space, we're barely seeing volume growth. So we are concerned about the fact that people earning 2 lakhs per annum or less in India, their incomes have stagnated over several years now. We're trying our best to figure out what the future holds for this strata of Indian society. But at the moment, I have to confess, the outlook does look grim for companies catering to the lower end of society. Thankfully, Nestle with its premium infant milk offerings and increasingly more premium offerings for pets, for babies, Nestle has very nicely, very cleverly premiumized the portfolio, and hence we sit quite comfortable with our investment in Nestle. They've grown volume growth at 9-10%, but other FMCG companies have struggled to do that. I think Suresh Narayanan and team have done a spectacular job over the last 6 years in dealing with the shift in India, where the rich are getting richer and the poor are getting poorer. Nestle has repositioned the portfolio, I think, very smartly over the last 6 years to play the affluence of, just to keep it simple, to play the affluence of CNBC viewers, and therefore we stay happy invested in Nestle.
Okay, that's on the consumption piece, but I do want to come back to this discussion on IT. Saurabh, I take your point that, it's a hallmark of, excellence when a company comes out with a conservative guidance. I get that. But what do you do when a company comes out and tells you straight up that there are cancellations that are taking place? I'm not talking about TCS, but Infosys, right? I mean, not only was the commentary uninspiring, but the company said that forget about deferrals, there are also cancellations that they're seeing in certain sectors. Now, those are some alarm bells that you need to look at. So if you're a long-term investor, say in a stock like Infosys, what do you do at a time like this? Do you just take a step back? Do you churn out? Because that's clearly what we're seeing large FIs do at the moment.
So Sonia, I'll tell you what we did this morning. In fact, just before I joined the call, I was discussing with my colleagues whether, Infosys looks tasty at the share price to me. Because, I don't see a problem here. This is a proven company. The great Nandan Nilekani is the chairman here. Salil Parekh's done a super job as a person running the company. I don't think the Western banking crisis is some sort of permanent state of affairs for the Western world. As we all know, it's been triggered by the Fed's rate hikes. I don't think the Fed's rate hikes are going to last ad infinitum. From what I know, only 30% of the Western companies have transitioned to cloud. So transition to cloud becomes a necessity for the other 70%. Technology is becoming more and more relevant for the whole world, including for the West. So given the scale of the opportunity in front of Infosys, given their track record, given their capabilities in helping Western companies transition to the cloud, I don't quite see what the dilemma is here. Yes, much like say Divi's Lab exiting COVID, if you have 4 banks blowing up in the Western world, you're bound to have some clients cancel your order book. If you're a large IT services company like Infosys, it'd be astonishing if some clients didn't cancel their orders. I mean, these are CEOs of Western companies. They're seeing banks will blow up in front of them. They'll cancel the orders. But should you and I get lost in that noise? I don't think we should. And this is where I think equity investors get a bad name when they sell Infosys on the back of the results earlier this week. I think sensible people out there should consider buying rather than selling Infosys at this juncture. We don't have it in CCP, but as I was saying, the way it got tonked, it looks to me to be a great opportunity in a company which has proven itself over now the best part of 30 years of compounding and 30 years of becoming more and more relevant for the Western world, a Western world which needs Indian IT services companies now more than ever before.
All right, Saurabh, just to clear the point, so you'll prefer TCS over Infosys as of now, but Infosys, it still looks like a very well-run company, and you'll are still studying it, right? So TCS over Infosys as of now.
Yeah, the smaller IT services companies we don't get so enthused about because they don't have the muscle. They don't have the muscle, the negotiating power, the recruitment power to deal with the scale requirements of large Western companies. But TCS and NP do. They're able to recruit successfully and cater to large Western companies.
All right. Well, differences of opinion make a market, right, Saurabh? And we're taking note of your points as well. Saurabh, final question before we let you go. You briefly mentioned that Amritanjan is one stock that you all have entered and Relaxo is one that you all have got out. And when we chatted the last time as well, you pretty much had mentioned these two. Any fresh additions that you all have made, say in the last couple of months or so, if you could share with us, or any stock that you all have exited as well?
Sure. So in our financials portfolio, Kings of Capital, we've added a company called Prudent Corporate. So these guys are on a platform on which 25,000 IFAs work. So these are IFAs who cater to, say, middle class people, lower middle class people. The IFAs go and sell the mutual funds, life insurance, general insurance. Prudent Corporate provides the platform. So it's basically let's call it a wealth manager for the mass affluent in our country. And we like the financialization theme, and we think Prudent Corporate is an interesting way for our clients to benefit from the financialization of, say, CNBC versus wealth.
Okay, all right. In fact, I was just going through the stock. Last year, I think the stock was at, 500 rupees? And now it's had a fairly decent run, 811 right now. That's the one you're referring to, right?
That's right, yes.
Okay. All right. Saurabh, we'll leave it at that. Great chatting with you. Thanks a lot. A very interesting and enlightening discussion. But we have to move on now and talk about the markets, which is very quiet at the moment. Not too much happening. The Nifty has given up on, that 17,750 level. It's just holding a little bit below that. It's a 20-30 point up move, and the Sensex is up 80 points. But what we have done is ended our fall from yesterday, which is a good thing. The Sensex still holding on to the 60,000 mark. Let's get an interesting discussion going now. A Prabhudas Leeladhar report indicates that seasonal products that we use, like air conditioners, fans, etc., the sales have been impacted because of unseasonal rains. Companies are also witnessing a slowdown in demand and high inventory. To discuss this, we are joined by Nilesh Gupta, the director at Vijay Sales, and Praveen Sahai, the research analyst at Prabhudas Leeladhar. So let me first get Praveen on board because he's the author of that report. Praveen, tell us a little bit about what you're observing, because, with the heat wave kicking in so early, one would assume that sales of air conditioners, fans, etc. would sort of hit the roof earlier than expected. But what are your channel checks indicating?
Yeah, thank you, Sonia. If I talk of Q4, that's because of the muted demand environment and inability to pass on the increased cost. That has impacted the consumer durable sector as a whole in the Q4. And that's also because of unseasonal rain, soft demand, and also the higher inventory of the seasonal products like of RAC and the fans, which the companies has built up in the Q3. So Q4 impacted because of that. However, our channel check in the month of April indicates there is some, decrease in the inventory level in the channel, especially in the RAC. So just to give you numbers like of 40 to 50 days of inventory in month of Feb, which has reduced to around 25 to 30 days as per our channel check. And also in the April, there is a change in the offer and the discount promotions which the brands are providing in the month of March because of some slackness in demand, which has gone from the system. So that's also indicates some positive indicator for seasonal products like of RAC especially.
Okay. All right. Hi, Praveen. Thanks so much for giving us your view. Well, let's get in Nilesh Gupta as well. Nilesh, good morning. Thanks so much for joining in. What's your reading of the situation? Praveen suggests that inventory levels are lower, so I'm guessing demand is strong. Unseasonal rains, did they have some impact? Could you give us your sense?
So, good morning, everybody. So this year we started on a very positive note because in the mid-February onwards only, in the month of February, from mid-February to end February, we had a good run of summer in the western part of the country and also slightly in the southern part. Not so much in the southern part. So what we expected was this year would be one hell of a summer sale, which we expected because it was onset of early summer. But what happened, everybody knows, in the month of March, the unseasonal rains came across the country and that dampened the sale to a large extent. And frankly speaking, till a week back, everybody thought that this time the summer season is a washout. But I do not know whether I should say luckily or not. But now, since the last 1 week, the summer has once again come with a big vengeance, and we are seeing sales coming up. So yes, the month of March, which we have lost, if the summer becomes more intense, we may be able to recover, or there may be a slightly lower sales than expected. But one thing is for sure, the inventory levels right now, nobody does corrections. For the simple reason is you have summer till the end of May. in the entire country, and in the north, the summer still extends till June and July. In fact, sometimes it goes up to August also. So corrections of inventory, whether in channel or whether in the brand, will not happen now. It will happen post 10th of May. Looking at the season, that is the time when retailers and distributors will start cutting down inventories if they feel the season is not going to go as it is. But looking at the last 1 week, I think we are sitting on a pretty good season now.
Yeah, got that point. Relation makes absolute sense that this is some western disturbance spells, I think, that have brought in the showers and brought some much needed relief actually in terms of the weather. But Nilesh, a word on average pricing. What trends are you seeing? By how much are prices higher over, let's say, the last season? And what's the customer response to it?
So basically, pricing wise, if you see over last season, we are nearly around 7 to 8% more. But nowadays, in fact, I've told this earlier also on your channel, pricing doesn't matter so much to the consumer because 80% of the sale is happening on EMI. So even when the price goes up, the corresponding effect on the consumer's wallet is not so much because the price gets, the payment gets divided into 18 to 24 months or 12 to 24 months. So price is not that big a worry for us right now. And one thing is for sure, now at least the prices have stabilized. So there's no worry of the prices going up again. So I think we are, it all now being a seasonal product, it all depends upon the intensity of the summer and nothing else.
Nilesh, is it still, you said 80% of the purchasing is happening on EMI. Are we still talking zero cost EMIs? Because otherwise, obviously, interest rates are higher. But is that the primary funding model, your zero interest EMI?
Yes, it's zero interest EMI, zero down payment also in some cases, and a long tenure. Earlier, the tenures of zero used to be only 8 months. But now we are extending up to 12 to 24 months also in certain categories.
Okay. Praveen, from the listed space and the stocks that you track, where do you see the maximum potential, both in terms of valuation headroom as well as growth here on?
Yeah, so in our coverage, we like a Havels over here because they are the one diversified throughout the different product basket, and in them the wire and cable from the last couple of quarters is doing well and expected to do well because of the real estate story as well as the B2B segment which are going to outperform, and in the Q4 also done very well. Secondly, on their ECD portfolio, it's largely on the fan segment, and with these regulatory norm change in the B side, they are going to get benefit out of that as well because of late in the last 3 years, they had excessively increased their distribution network under Rudder Vistar. So on that front also, we are expecting some improvement in the top line for them. Apart from that, the Lloyd, which has gained the market share for them, and definitely we understand that there is continuous losses with the Lloyd, but as for the management as well, these losses will minimize, and we are also expecting the losses related to the Lloyd will minimize with the opening of their new manufacturing units in the south. So some logistical benefit they will receive. So overall, I believe that's out of all our coverage, Havels to outperform from here onwards.
Okay, all right, Praveen, I wanted to ask you about Blue Star. We get the management and they have been telling us that they've been gaining market share. Now they're putting incremental capacity. Do you see a market share shift? Maybe Blue Star gains and Voltas loses out, or do you think someone else will lose out in terms of market share?
So you are rightly pointed out that's a Blue Star which has performed very well in terms of the market share over the last 2.5 to 3 years. And with the opening of the commissioning of their manufacturing unit in the south, and their target also to improve their market share from 13.3% to 15%. So I also believe that the competitive intensity in the southern market is going to increase, especially for the Voltas, because not only the Blue Star, the Lloyd, Daikin, they are also coming up with their manufacturing units in the south, and we will see some logistical benefit for them. and that definitely will give a competition to the Voltas in terms of the market share. So definitely the Blue Star, the first mover to get the commission their manufacturing unit, and will see some market share shift as well for them.
Praveen, just before we wrap, my final question to you, what are you expecting in terms of margins for a lot of these durable companies? I mean, we'll also hear from them as we get through the earnings season. But in general, what are the trends like on margins, keeping commodity costs in mind?
So in the entire durable space, we will see some around 30 to 40% of improvement on sequential basis in the margin, whereas on the YO side, we still see some 70 to 80 bips of deterioration in the margin. Because the copper prices, which has gone back, and that's an increase. However, some of the segments like of a wire and cable, which are able to pass on the prices, they have taken already 3 to 4% of a price hike in the fourth quarter. So there would be no much of an impact, or even I can say they will benefit in the margin side, whereas the other segments in the ECD side, with the elevation in the cost and the demand sentiment quite muted, we are expecting the overall sector to see some kind of a deterioration on the YOY side in the margin front.
Okay. All right, got that. Thank you very much, Nilesh and Praveen, for joining in and giving us your sense of the consumer durables market and, of course, how different companies are poised. The market, by the way, is getting very, very quiet. Now it's only a 8-9 point up move, so it's a little tough going for the bulls. Bank Nifty is doing quite okay, but there's a lot of drag from other biggies like Reliance, like HUL. There's more selling, by the way, on TCS, guys, so not that easy. ITC is lower. Now we're just 1 point up on the Nifty. This looks like a market that could it's slip and slide. So yeah, not quite playing out as per script as the bulls would have at least hoped for.
Absolutely. But let's do one thing. Let's take a quick break on that note. By the way, lots happening at the Apple Store at the moment as well. So we'll try and cover that in greater detail too, all the action in case you're missing out on it. Sandeep Jain of Monte Carlo Fashions is also another guest that will be joining in just a while to talk about sales for the month of March. Later in our special segment, Charting Trends, Rahul Sharma of JM Financial will help us decode charts and technical trends in the market.